Hey there. Thanks for tuning in to RTD News Updates. As always, if you find today's articles to be informative as well as educational, feel free to share them with your family and friends so they can become more monetarily aware on issues relevant to their own finances. And if you're new to RTD, click the subscribe button below for more RTD News interviews as well as news updates. Let's get into today's articles. Today's articles have more to do with the easing concept of quantitative easing that is currently underway and what is expected to come in the days ahead. And of course, the Deutsche Bank fiasco as it unfolds, and just typical banking policies and monetary policies around the world and how they're failing. So, first article here is Fed's Fischer says near zero rates QE may be the future. Next article, Deutsche Bank is latest victim of America's Treasury war. Third article, Deutsche Bank announces extra 1,000 jobs to go in Germany. Next article from Zero Hedge, the new too big to fail, EU proposes taxpayer-funded derivatives system bailout. Next one, no sign of ECB ending massive easing program. And then the last one here has to do with the sterling. It says sterling falls to record low against top trading partners. So let's dive into the very first article here. So here we have an article from CNBC, and it's from the second person in charge for the most part of the Federal Reserve. It's Fed's Fischer says near zero rates QE may be the future. So ultimately, at the end of this article, all it basically says is that the current policy they're on, because of a lack of growth, more so, is the reason why there will more likely be a expectation of being near zero rates for years to come, just because there's no real way they can really begin hiking for per se when there's no growth and no quote unquote measurements that they need to really raise rates back up to what they are normally. So basically said we're entering a new world where zero and possibly QE down the line is things that will become normal. So just to give you an idea of what some of the things he actually mentioned, it says evidence that the so-called natural rate of interest has fallen to low levels could mean the economy is stuck in a low growth rut that could prove hard to escape, Federal Reserve Vice Chair Stanley Fischer said on Wednesday. Speaking to a central banking seminar in New York, the Fed's second in command said he was concerned that the changes in world savings and investment patterns that may have driven down the natural rate could prove to be quite persistent. We could be stuck in a new longer-run equilibrium categorized by sluggish growth. As a result, he said central bankers may face a future where the short-term interest rates set by policymakers never get far above zero. And so keep in mind, this is also the gentleman that mentioned several weeks back that even though that the zero or near zero policy hurts savers and hurts those that have normal deposits, but it's quite good for those that are in the stock market dealing with equities. So he kind of admitted that the mainstream, the public who tend to want to save, is not really beneficial as far as their policies for them, but it's quite beneficial for those that are in the stock market, which are those higher income earners and investment and things like that. More people who are concerned with their portfolios per se in regards to stocks than their everyday paycheck savings and things like that. So as a result, he said central bankers may face a future where the short-term interest rates set by policymakers are near zero. Ultra low interest rates may reflect more than just cyclical forces, Fischer said, but yet another indication that the economy's growth potential may have dimmed considerably. So basically, his excuse is that because there's no growth, we're going to stay near zero. And then he already mentioned weeks ago that being at zero hurts savers. So I don't really think the Federal Reserve or central bankers' policy in general is designed to help the public in general. So it's good to say that zero or below and QE is the only solution that will be available for these guys in the days ahead. So if you're interested, articles below. Here in our second article from the Telegraph by Mr. Ben Wright, it's entitled Deutsche Bank is latest victim of America's Treasury war. And so it looks like a recent book was written entitled Treasury Wars by Juan Zarate. And so it looks like a lot of bank executives, as he's calling off here, Stuart Gulliver, executive chief of HSBC, Lloyd Banks, Horacio, Peter Sanders of Standards Charter, all these gentlemen here, how they've kind of jumped aboard and grabbed a hold of this book called Treasury Wars. And basically what the author has done in this book is kind of illustrated how over the last couple of years, how the U.S. has really used the U.S. Treasuries market through the Department of Justice with all these recent fines and whatnot, and having pretty much enforced themselves upon different countries and banks, imposing fines of all types of sizes for the sake of threatening them for the most part, saying that, hey, if you don't kind of live up to what we're trying to do here or play along with our game, we'll just isolate you by not allowing you to use our the dollar clearing markets, and basically isolate you from the global financial system. So a lot of banks, institutions, countries play along and accept these fines without really being able to protest because they don't want to be locked out the system. And so it goes through just a couple examples of what that has been like, dealing with Iran, North Korea, and Syria. Basically just removing them from the system, isolating them to where they can't really transact and do business. Then it talks about recently how the General Motors was fined $900 million based upon a faulty ignition switch, which led to 174 deaths. Then it kind of heads into Deutsche Bank and where we're at now, and how the whole recent fine of what was labeled as $14 billion and how that came about and why now, things like that. And basically just tying all this recent activity with the Deutsche Bank situation into this book of Treasury Wars, where basically the American policymakers are using their strong hand, having the world reserve currency, to basically bully and push people around without much the people can do about it at this current moment. So basically he just concludes this article going through how this whole Deutsche Bank fine, depending on how it's worked out, if it's worked out, will kind of determine the direction of Deutsche Bank based upon consumer confidence and depositor confidence, saying that if they are able to actually negotiate a reasonable fine that the Deutsche Bank actually has within their their vaults or whatever, it'll be easier to pay that without much disruption in the financial market as far as confidence in Deutsche Bank's solvency overall. But if the fine is something they can't manage to pay and they have to do some funding for some fundraising for the most part, then the Department of Justice might get greedy and ask for some of that, which will really begin shaking confidence in those who have deposits and do business with the bank, which could then trigger a crisis of some kind. So that's ultimately what it was about, whatever. But yet, based upon this book here of Treasury Wars, and how the author is saying that it's really bringing out some strategies on how the U.S. have cornered nations and banking institutions and pretty much everybody by threatening them to isolate them from the global banking system. So interesting article. If you're interested in reading it, articles below. Third article here from CNBC's more news on Deutsche Bank. It seems like Deutsche Bank will be the topic of discussion for several days, weeks, months, until something is worked out as far as its solvency overall, or it's something it causes it to go under, which a lot of people believe that it might end up being the case. So Deutsche Bank announces extra 1,000 jobs to go in Germany. And so just to give you an idea of what's going on, it says, embattled German lender Deutsche Bank announced Thursday, which is today, that an extra 1,000 jobs will be lost in its home nation as part of a restructuring plan. It said that it had reached an agreement with its workers' councils on role reductions in Germany, stating another 1,000 jobs will now be reduced in Germany on top of the initial plans for 3,000 job losses. This brings the total number of role reductions in the country to around 4,000, which is a part of the 9,000 jobs being reduced worldwide to make the group more competitive as a part of its strategy. So all these massive numbers, 9,000 total layoffs. So that's 9,000 unemployed people entering the economy that once upon a time thought they had security within their job and thought that everything was all fine and dandy. But yet, because of Deutsche Bank's policies, business practices, and all that, things like that, is leading to a lot of people to question their ability to remain employed with that institution, because they're not. We consistently implement our strategy to make the bank more efficient, said Karl von Rohr, member of the Deutsche Bank's management board, in the press release on Thursday. We are fully aware that today's decision is a difficult change with significant personnel impact for many employees. We will ensure that any staff reductions are carried out in a socially responsible manner. Shares of the bank climb higher on this news, and we're trending up to 0.5% at 1:30 this afternoon. So basically, it did the company good to announce that they're going to cut back and save, several $1 million in firing people. So it's unfortunate for those that are being fired, but I guess good for overall banking industry. And with Deutsche Bank, it just helps save a couple more dollars and helps keep them alive for a couple more days. So articles below if you're interested. Here's an article here from Zero Hedge entitled "The New Too Big to Fail EU Proposes Taxpayer-Funded Derivatives System Bailout." So ultimately it talks about it would appear that the powers that be have stumbled onto the ugly fact that all the bailed-in depositor money in the world won't stop the innovated, rehypothecated collateral chain collapse contagion at Deutsche Bank's 40 trillion plus derivatives books. Damocles sword hands over the status quo. However, being in the problem-solving type, the European technocrats have a fair share solution. Back a derivative clearinghouse with taxpayer money to solve the new too biggest to fail problem that no one saw coming. So ultimately, this little article here talks about, it just basically brings to the light what was already known for the most part from the world, that the derivatives banks on Deutsche Bank alone is unbelievable. And it talks about the German economy here, and it gives you a little graph as to how massive it is. The German GDP is 3 trillion, European Union GDP is 14.6, but the Deutsche Bank's gross derivative exposure is 42 trillion. So just to go to show you, there's more tied up into these bets and all this stuff that they've created, Deutsche Bank as an institution, that they've put themselves in the middle of something that's more than what they can handle. So it all falls back onto the public. That's ultimately what he's saying. So they're beginning to work on different things now. Here's another little graph of how systemic risk among globally systemically important banks are, with Deutsche Bank in the middle, showing how all these banks here all around the world are tied in. You got Wells Fargo, Citigroup, Morgan Stanley, Bank of America, Goldman Sachs, JP Morgan, Bank of New Mellon, ICBC, BNP Paribas, RBS. All these banks are tied into this big, humongous blob of basically debt / gambling that the banking sector embarked upon, that the public will have to pay out for the most part. Then it goes on to talk about just some recent meetings and some policies that's been put in place, and how the biggest problem is just the clearing houses that have kind of been the middleman between the two derivative parties, and that there's no way that if there's a loser, the loser won't have enough money to pay out to the winner, so the winner's going to lose. So basically the person in the middle gets kind of shafted. So they're kind of trying to come up with ways of trying to keep everything from really imploding on either end of the loss, by basically saying that the clearinghouses will need support, and that support will more likely come from governments needing to participate in either buying equities directly to fund some things, or just ultimately purchase all this fraudulent activity between all these banks and things like that. So ultimately the end of the story is the people will be held responsible for keeping things afloat, because the banks are too big to fail, even though they are the ones that caused the mess. But yet the governments will step in, as they're proposing, even in this little bit of excerpt here. That is what will happen when something happens. So they're basically preparing now via paperwork and things like that to kind of say, hey, we already had this in place. Can you please come in and save us? Yada, yada, yada. So articles here if you're actually interested in reading more about it. Here's an article from RTE, and it says, no sign of ECB ending massive easing program. And so this is actually an update to their prior meeting that was held in September. But basically at the end of it, were set to kind of wind things down March of 2017, and ultimately they basically saying that there's no way they can really stop counterfeiting money and bailing out and pumping liquidity into different countries by buying junk in the form of quote-unquote bonds. So they have to keep things going, all in hopes of reaching their, as they put it towards the bottom, stability, their price stability objective of trying to reach 2% inflation. And so they're saying if we stop counterfeiting money now, there's no way that we'll be able to push up prices to where we'll be able to meet our 2%. So they're saying that they're going to ultimately have to change the rules at which they're playing by, and so basically give themselves more authority to basically begin buying, true junk, as far as calling it assets, buying, bonds and things like that, which is all debt that will never be repaid. So I'm not sure how they're still using the words assets, purchasing assets. But basically it's saying that they're not able to buy any bonds that yields lower than the deposit rate at which the bank pays to part cash with it overnight, so at 0.4%. So they can't buy any bond that's already lower than negative 0.4%. So basically they may change that rule to say, hey, we can buy bonds up to negative 1%. So basically, we're giving you free money. Here, take this free money and do something with it. And so they're going to try that. So ultimately, they're going to change the rules, bend the rules to fit what it is they need to do, which is basically counterfeit more, which ultimately hurts savers, hurts pensioners, hurt everyone that relies upon the euro as something that's supposed to be stable as far as being able to preserve purchasing power, which people are going to see at a much faster rate how hot euros will become when people start to get rid of it and when a velocity picks up. So articles below if you're interested. Here's an article out of the Telegraph having to do with the recent devaluing of the sterling, falling to record lows against top trading partners. And so here the article is presented with a couple Q&As that's being asked. And so just give you an idea of where it's leading to. It says sterling was already at a 31-year low against the dollar, falling sharply in the wake of the Brexit referendum. And again, once the Prime Minister confirmed she intends to trigger Article 50 by the end of March. On a trade-weighted basis, the pound is down 14% since the start of June, the month of the vote. To put it in a longer-term context, it has fallen 36% over the past decade and is now firmly below even the low levels experienced in the financial crisis and following the exchange rate mechanism plunge in the 1990s. So since, that's amazing. So to put it in longer terms, it has fallen 36% over the past decade. So since 2006, it's fallen 36%. And so just being able to kind of see how this piece of debt paper has been devalued over the years is incredible. And so ultimately what that means is that as a citizen in England holding on to pounds in your bank account, if they were just stagnant, just standing there, during this time frame, you were at least getting some type of interest on your money to where it kind of counterbalanced the whole idea of 2% inflation, or it could have been more at that point, where now you have no interest on your savings and it's parked there. And then the true inflation rate, I'm sure, is well beyond the 2% that they're targeting. So it's basically just corroding away as far as what you're able to purchase with that paper over time. And ultimately, through all these Q&As here, it ultimately gets worse. And so, yeah, it's a couple good questions here, and it's answered. And ultimately, what it boils down to, at the end, he says that the sterling pound will end up going lower at the end of the day. And so, basically, knowing that it will never regain the purchasing power it once had, it will be kind of unwise to solely have all your energy, your power, your future tied into this particular piece of paper, as well as any other national currency on this planet, being that they're all government-backed, debt-based instruments. So just a little something to think about. Hope you guys enjoyed these articles today. As always, if you find them informative, please share these so we can get the word out there to help people become more monetarily aware on subjects such as the sterling falling to record lows, because one day it will say the dollar falls to record lows, and at that point people will be able to feel it truly. So I want to educate them before they're actually able to feel it per se. Anyway, subscribe if you're new. Looking forward to bringing you more news. Until we meet again. Thanks.